Welcome to GRE. I'm your host, Keith Weinhold. I predict how much housing prices will rise or fall next year. Also, learn why the higher mortgage interest rates expected next year typically mean higher house prices are coming, not lower ones, and why higher mortgage rates mean lower housing supply today on Get Rich Education. The annual Spartan Summit is on. I was the kickoff speaker at the last event. This year they are back in person, and the keynote speaker is none other than Shark Tank's Damon John. Learn from industry experts on real estate, tax strategy, lending, and entrepreneurship. You'll also get to tour tangible turnkey income property in growing Alabama markets. It's coming February 16th to 18th in Birmingham, Alabama. Get your ticket or learn more at SpartanInvest.com today. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Ankara, Turkey to Anchorage, Alaska, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. You know something? You are winning. As an investor, you are winning today if you've been following my plan since the first episode of this show more than 7 years ago, and you haven't only been learning on the show, but acting on this information. So much of this is coming true now. And it's part of our formula that makes GRE different. Yes, you are getting paid up to 5 ways at the same time. You have learned to not just deploy your money, but to leverage other people's money on the way to doing that. You know that financially free beats debt free. And you're doing it ethically. You're providing others with good housing that is clean, safe, affordable, and functional. Doing the right thing before you do things right. You understand that you don't get ahead by getting your money to work for you. Yeah, if you happen to be a new listener, you heard that right. That's a paradigm shift. You get ahead by getting other people's money to work for you. And real estate is what lets you do that 3 ways at the same time with a rental property, because you're using the bank's money for the loan, the tenant's money for the income, and the government's money for generous tax incentives at scale. Since this is your last life ever, don't be content to live below your means for too long. You are expanding your means here, and you're not quitting your daydream either. It's not as much about your return on investment, though that's certainly important, but it's more about your return on time invested. And now with a newer term that I introduced about 2 years ago, this term was not around at the inception of this show in 2014, but I was ahead of this inflationary shock. It is that, as I like to say, you are winning the inflation triple crown. Yeah, you're winning with inflation 3 ways at the same time now doing what we do here. Congratulations to you. And all these things I'm mentioning are enduring GRE mantras. It's kind of like a game reset here. These are maxims. These are as holy as the 10 Commandments. Well, no, not quite. But this is who we are. This is the kind of investor that you are. And yeah, now it takes applying a fair bit of counterintuition to some of these, which would make sense because you can either be a conformer or you can be wealthy. You need to pick between those two. Either you can focus on a 401k or you can be wealthy. You can either trade your time for dollars and sell your time for money for 40 or 50 years, or make those unconventional sets of decisions that set you apart. And speaking of non-conforming, let me share something with you that my late grandfather told me about real estate. He told me this about the time that I was in college, so I didn't own my first home yet at that time. Grandpa told me, Keith, buy yourself a fixer-upper. Yeah, buy like a property cheaply that needs to have a lot of work done to it. That was his advice. Buy a fixer-upper. Now I'm going to tell you that as much as Grandpa loved me and I love him and he meant well for me, I think that's the wrong advice in today's environment. It might have made more sense to buy a fixer-upper back in Grandpa's day, but not today. And I'll tell you why. And yes, if one does know specifically what they're doing as a house flipper, then the fixer-upper might make sense if you're approaching it that way. But for most, this does not do so much for that ROTI, that return on time invested. And let me explain why. First, Grandpa was kind of handy around the house. He was an electrician, and I am not handy. And no, by the way, this is not the husband of my late Grandma Weinhold that I used to reference on the show here. Instead, this was my mother's father. And back in his generation, mortgage interest rates were a lot higher. You were less likely to want a loan. I mean, heck, mortgage interest rates crested over 18% in 1981 for a 30-year loan. So what makes more sense today is to buy a cash flowing property that's already fixed up, whether that's a brand new construction place or a fully renovated property, and borrow 75 or 80% of the value of that property. Because here's what you need to understand in today's economy, not my grandpa's economy, although I know he meant well, and he might have even been right back in his day, where he was coming from there in Berks County, Pennsylvania, which is where he was from and where I was born, by the way. This is not your great uncle's economy or your grandpa's economy or really not even your mom or dad's economy. But this is the reality of the economy today. Okay, look, I really want you to understand the gravity of what I'm about to tell you. You understand the significance of this. Look, earlier this month, when the government reported that their inflation number came in at 6.2%, and we currently have mortgage interest rates at 3.1%, do you have any idea of this opportunity for you to be a savvy borrower? This is almost incredible. Not only is inflation greater than what mortgage rates are now, which is remarkable in itself, but inflation is fully double what mortgage rates are, 6.2% versus 3.1%. So here's what this means, and really why you wouldn't want to buy a fixer-upper or certainly pay all cash for a property. So today, with inflation double what your interest rate is, you get a loan from the bank, and now each month, when you repay the bank, the dollars that the bank has to accept from you get debased twice as fast as the bank's interest charges can accrue back onto you. If you understand that, you have financial intelligence. And if you act on that and you control your cash flows, you have financial wealth. I won't say that again. You have the ability to skip back and listen to that part. That is the opportunity today. That is emblematic of today's high inflation and low cost of money environment. That is exactly why financially free beats debt free. In fact, in the history of this show, that mantra has never been more true than it is today. And that's why you're winning. And why else are you winning? When your mortgage rate is lower than inflation and you buy a rental property, ostensibly, even if you never rent the property out, you could be dollars ahead. That's what that means, even if you never rented the property out. But you know what? I'm going to suggest that you go ahead and rent it out with that 75 to 80% loan on it anyway. Renting it out is where 2 of your 5 profit centers come from, after all, cash flow and the tenant-paid return on amortization. So yeah, go ahead and rent it out anyway. Even though when inflation is double your cost of capital, you're still going to be dollars ahead. It is certainly not Grandpa's financial world at all. And in a sense, with this upside down world, consider that now debt is an asset and cash is a liability. That's what this inversion means. That is today's economy. I want to talk about what you can expect in next year's real estate market in a minute. You know, wealth accumulates fast when instead of owning one property paid off, you own 5 properties with 20% equity. And I have been getting a lot of thanks lately. Really appreciate that feedback. I want to tell you I'm really grateful for that. Sometimes I even get paper letters in the mail. Here recently, I've received written thank yous with an ink pen in an envelope. It's really cool to get these. I've gotten them from Massachusetts, Pennsylvania, Virginia, California, and Oregon. And by the way, you can always get a hold of us in most any form at getricheducation.com/contact. You can get a hold of us there by voicemail, email, paper letter, and more. That is at getricheducation.com/contact. And I want to tell you thanks as well. You know, it was Thanksgiving not long ago. I still find out that when new listeners learn about our show, they want to go back and hear every single episode, which is something that I'm grateful for. And it's actually pretty remarkable now that we are on episode 373 today. Let's talk about the future. What is coming for the housing market next year? I was actually on television last week talking about what's ahead for the housing market next year on New York City-based NTD television. Shout out to Paul Greeny and everyone there at NTD. Why don't I do this? I'll largely talk about what I expect to happen in next year's housing market from a principles-based perspective. And that way, this material that you get and this knowledge that you have, it's never going to get dated. Next year, both higher home prices and higher mortgage interest rates are expected. I expect that. Fannie Mae expects that in their predictions. A lot of economists and agencies predict that they are both going to be higher. With the Fed tapering asset purchases, that basically means that they're slowing the flow of new dollars being pumped into the economy. That's already started. So fewer dollars, well, that means, okay, with dollars getting more scarce, then when something gets more scarce, it gets more expensive. Well, since an interest rate is the cost of money, well, then borrowing costs rise. That's how that works. After the taper, most think that the Fed will directly raise rates around the middle of next year. We'll see whether or not that part happens. But the pressure to push up rates is real. It is palpable. It's there. Now, do you find it interesting that both higher home prices and higher mortgage rates are expected? Do you think that higher rates means that housing affordability is hurt and therefore it suppresses prices? A lot of people believe that. I mean, after all, with a $500,000 loan, a 3% interest rate means your payment's about $2,100. Well, if rates go up to 5%, now your payment's almost $2,700. So isn't that right there proof that higher mortgage rates have to mean lower housing prices because of that affordability constraint? No, it doesn't. Actually, that is one of the biggest myths in all of real estate. In fact, I asked that question over on LinkedIn, and 31% of people got it right, maybe only because they follow me, and 69% of people got it wrong. Only 31% of people correctly said that higher mortgage interest rates correlate with higher prices. That's what happens. When rates rise, home prices rise as well.
What you talking about, Willis?
I'll tell you what I'm talking about, Willis. That, of course, is the disembodied voice of late child actor Gary Coleman from Different Strokes. Look, a lot of people get this wrong. Even experienced real estate investors get it wrong. Look at history more than hunches. Since 1994, there have been 6 distinct periods where mortgage interest rates rose. And of those 6 rate hike periods, how many times do you think that home prices rose versus fell? Of those 6 higher rate environments, all 6, the most recent ones, do you think that prices went up 3 times and down 3 times, or 4 and 2, or 5 and 1, or any idea there? You might already know the answer if you read our newsletter and watch our GRE YouTube channel. The answer is, during the 6 periods of rising mortgage rates from 1994 up until today, home prices rose all 6 times. And it's predicted to happen again because both rising rates and prices are expected again next year. We are all set for it to happen a 7th consecutive time. That's the extrapolation. Go with history over hunches. The reason higher interest rates lead to higher prices is that you've got to zoom out and look at the broader economy. When interest rates rise, why do the forces that be hike up rates like that anyway? Well, they have to do that in order to cool an overheating economy and get on top of inflation, just like they want to do again now. Rising rates are a response to a recovering economy, to an improving economy, to an economy where there are even more available jobs than there are people, just like right now. So rising rates are a confirmation that the economy is strong. See, when there are more jobs than people like there are now, employers have to compete for workers. And how do you compete for a limited pool of workers? By offering more money. That is inflationary. And then people feel secure in their jobs when there are about 10 million more available jobs than there are people, just like with what we have today. And what do people do when they're secure in their jobs? They are more likely to do what? Put down roots and buy a home. So when it comes to why rising mortgage interest rates correlate with higher prices, which is counterintuitive to a lot of people, the least that you need to remember when it comes to the future direction of home prices is that strong economies are more important than interest rates are. Fannie Mae predicts that home prices will go up by 7.4% next year. I think that sounds about right, although it could be more like 9 to 10% price appreciation next year. That's what I believe. And that would be less than the 15 to 20% appreciation of this past year. And why don't I think appreciation is going to be that high again? Well, because at some point there is an affordability constraint. And why don't I think that appreciation will be much lower than 9 or 10% next year? Well, because the economy is strengthening, like I just mentioned. And the other big factor is that we still have super low housing supply. Now that you know higher interest rates mean higher prices, and now that you know I expect national housing prices to appreciate 9 to 10% next year, let's talk about that low supply of available houses. The higher mortgage rates expected in the future actually mean that the supply of housing cannot increase fast enough. Yes, higher rates mean a lower supply of housing. And let me explain why shortly. And today, you're not just getting some predictions about the future of the housing market, you're also learning about some real estate economics. So, housing supply is already down 60% or more just from 2 or 3 years ago, and rising rates are another factor that is most likely to keep supply suppressed. I'm going to give an explanation on that straight ahead. And hey, if you haven't, go ahead and subscribe or follow the Get Rich Education podcast here on your podcatcher of choice. We have reliably made sure that every episode is a good return on time invested for you. If the topics of real estate investing, which is kind of what we major in here, or our two so-called minors of real estate economics and the overall mindset of wealth, if those topics interest you, I would be grateful for your GRE podcast subscription. It is free. More next. I'm Keith Weinhold. This is Get Rich Education. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. There will only ever be one, episode 373, and you're listening to it. How about a shout out to our loyal sponsors, most of whom have supported us for years. To show your thanks, what you can do is in turn support them, many of which I have used personally. A lot of these are the same services that you would want to leverage anyway. Ridge Lending Group, they specialize in investment property loans for the 1 to 4 unit type especially. They've helped more families achieve financial freedom than any other mortgage lender in the entire nation. It's where I got my last few loans personally. You can get started at ridgelendinggroup.com. The EQRP company, forget about puny IRAs and their tiny contribution limits and limited investment choices. An EQRP is even better than a self-directed IRA. You can invest in nearly anything with an EQRP. The tax treatment is better, and the contribution limits are about tenfold of an old-fashioned IRA. To learn more, go ahead and text EQRP in all capital letters to 72,000. Then there's JWB Real Estate Capital. They have all new build, brand new construction build, income properties in one of the very, very best markets in the nation, Jacksonville, Florida. Yeah, real property that you can own and get paid all 5 ways. Start at cashflowandgrowth.com. Then there's B2R Direct. They offer new build single-family homes all the way up to small apartment buildings in Central Florida, another thriving market where the numbers make sense. You can get started with them at the letter B, the number 2, the letter R, direct.com, b2rdirect.com. Then finally, you should know about the Spartan Summit, a live in-person event coming up February 16th to 18th in Birmingham, Alabama. Look, you're going to get a tour of Alabama turnkey property markets when you attend the event, and that's something alone that you would probably want to do anyway. Plus, you're going to get to meet other investors like you that are there for the event. And then plus, at the Spartan Summit, you're going to get to learn from a bunch of great speakers. I was the kickoff speaker at the last Spartan Summit. This year, it is headlined by Shark Tank's Damon John. You'll get to see him and do all of those other activities and more. Again, it is February 16th to 18th in Birmingham. Tickets are just a few $100. Get started at spartaninvest.com. And besides using these services myself, I have been inside these offices. I know and have met these people. I've been inside Ridge Lending Group headquarters and Chaley Ridge's office in Portland, Oregon, and inside JWB's office in Jacksonville, Florida, and inside their turnkey properties. And it's the same with EQRP and Spartan Invest, both of whom are in Birmingham, Alabama. I don't ask for anything myself. This show has never taken donations. You might just support those who support us. That's who they are. American housing supply has been low, and it's going to stay low. How low? Well, for consistency, let's just stick with the Fred active listing count, because these are the same figures I've been stating to you for months now. Well, for years, the active listings were between 1 million and 2 million housing units at any given time. In 2016, it was still above 1.5 million. In early 2020, they fell strangely low, below 1 million. The housing shortage got bad. Well, at the start of this year, they fell off a cliff to below 500,000 active property listings. And today, do you know where we're at today? Do you think the supply has recovered? Not even close. It is still just 636,000 available units through October. Builders don't have the labor to build homes fast enough to keep up with our U.S. population that increases at 1 to 2 million more people every single year, and they all need to be housed somewhere. And even if builders could keep up, they're often still lacking the materials that they need, like roof trusses and cabinets and door hardware and drywall. Besides the rising population, what really matters, actually, to be more specific, is household formation. It's that amount of new household formation. See, a lot of roommates can't stand being home together now that more people are at home working on Zoom. So many of them want to separate and form their own household. I think I mentioned before here already that the most populous age cohort is younger millennials, ages 25 to 34, and they are the ones that are in prime household formation years. So all this demand, such little supply, that puts upward pressure on prices. Well, you know what else constrains this tight housing supply even further? It is higher mortgage rates, if indeed they go higher. Yeah, higher mortgage rates correlate with even lower housing supply than where we are right now. Now, why is this? Actually, you have the answer to this question inside of you right now, but no one has ever asked you the right question. Here is that question. Let's use this as an example. Say that you live in a home and you've got a 3% mortgage rate on it. When rates rise from 3% up to 5%, how likely are you now to move out of your home? Well, you're not very likely to do that because you would have to pay more just for an equivalent replacement home. You don't want to lose your 3% rate. You lose that rate if you sell the home. So you don't put your home on the market and you stay put. And so many other people in your situation feel the same way. Well, what happens when people don't put their home on the market, or else they'd have to pay that higher rate? Well, fewer homes on the market further constrains supply. Yeah, it crimps an already low supply. This is why I said that you already have the answer inside you. You just never asked yourself the question as to how you would behave when mortgage interest rates rise on you. This is part of the real estate economy that has intersections with behavioral psychology and sociology and personal finance. Now, like I said earlier today, rising rates also confirm a strong economy. So some people, though, a few, they will stretch and go for a move-up home, even with higher rates, but just fewer of them. And now you know why higher mortgage interest rates lead to lower housing supply. Though understand that few think mortgage rates are going to shoot sky high next year. Mortgage rates are 3.1% right now on a 30-year fixed owner-occupied loan. Fannie Mae expects them to average 3.3% next year. That seems like a good guess. I've been talking about what you can expect in the future today. A lot of people are interested in what might happen next year. Really, you are interested in that in every facet of your life, from fitness to finance to relationships to spirituality and more. Where's next year going to take you? And we mostly discuss the real estate angle of that here at GRE. I would like to remind you, don't get too caught up in the future because it's all speculation. Probabilities and correlations are all that you or I can ever really contemplate. But you know what you can control? It's what you can do right now. Sure, you probably do want to buy more property before prices and rates are both higher next year, if indeed that happens. But as I like to say, ultimately, you aren't in this for the income. You are in this for the outcome. The greatest risk of all to you in your life is spending your life not doing what you want to do. So get yourself in a position where you can buy yourself the freedom. It's not really the money that you're after, it's the freedom. There is one thing that I know about you, at least here on this earth, this is your last life ever, and you have never had less time remaining in your life than what you've got left right now, there is simply not enough time for you to wait for the perfect schedule or the ideal weather or the pristine financial situation. There's no time for you to wait to have just the right physical fitness before you try something. Whether that's visiting Ecuador's Galapagos Islands or singing karaoke in front of people, even if you're afraid you're going to look dumb, which is something I actually did recently, there's no time to wait to climb Kilimanjaro or postpone adding a rental property. The future is full of maybes, so do it now. That's how you can grab onto a certainty, because this is, in fact, your last life ever. And you can be grateful for what you have, yet want to expand your means at the same time. And ultimately, you and I are pretty lucky. It's unlikely that we're ever going to have to fear not having a heated home or clean drinking water. So you can't expand your means at the same time. Coming up in future weeks here on the GRE podcast, Tom Wheelwright returns to talk about how to whittle your taxes down to almost nothing before year end. He's actually going to join us twice in the next couple months. 2 new guests are making their GRE debuts. We're going to go high level with Professor Dr. Randall Wray about how government could have prevented this high inflation and more. But first, next week, Doug Casey will be here with us. It could get somewhat controversial. Doug is going to talk to us about how freedom and liberty relates to real estate investors. Now, I don't think that any of those topics should be controversial, but that's how some people perceive those topics today. Some people are going to get offended on next week's show with Doug Casey and I. And where he and I are aligned is that we are championing free market principles. When I was in my teens, I thought things like, it's just horrible that they're sending astronauts to the moon when there are poor people down here on Earth. Well, with the passage of time, I've learned that it'll always be that way. Some people choose to live below their means rather than expand their means. If the government makes everyone equal and we're a collectivist state, then few have the incentive to innovate or even work hard. So we're going to expand on those themes. That's next week for Doug Casey and I, where some people could be offended. What you learned today is that my best projection is that housing prices will appreciate nationally 9 to 10% next year. You learned why, paradoxically, higher mortgage interest rates correlate with higher home prices and why higher mortgage rates correlate with a lower housing supply. That is the big summary. Like I've said before, I would love to have you as a subscriber to the podcast here. Understand that this show is just 1 star in about a 5-star GRE constellation. This is only one of the ways that I reach you and help you expand your means through real estate every week. The GRE constellation is this podcast. It is our newsletter called the Don't Quit Your Daydream Letter. It's our YouTube channel, our website, and then the place where you can actionably purchase property at greturnkey.com. And hey, now it's up to you to decide whether this constellation is full of bright, shining stars or a whole bunch of dimming stars. That's up to you. Some podcasts have YouTube channels where all those channels are the video versions of the podcast. And there's nothing wrong with that, but GRE's YouTube channel is more than that. A lot of the podcasts aren't on YouTube at all, although many are. Many of the videos over there are just me teaching you, me to you, one-on-one, about building your wealth so that I can show you charts and more visual aids to help support your learning over there. So again, check out the entire GRE constellation, which is, at least as I'd like to think, full of shining stars. If you like learning about real estate investing and economics here today, you'll love it over there at Get Rich Education YouTube. Until next week, I'll be back next week with Doug Casey. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
preceding program was brought to you by your home for wealth building, GetRichEducation.com.